Okay, so we have one more session and then there will be a break, I promise, and coffee and tea and not quite alcohol because they said we couldn't serve it yet. I want to introduce our next guest. He is the founder and CEO of Social Capital, Chamath Palihapitiya. So Chamath, you've had this long career. I mean, you started AOL back when AOL was a thing, Facebook, Social Capital, and we will talk about all this. But most recently, or more recently, the reputation you got over the last couple of years was as the SPAC king. So yeah, you might not want the crown now, but you had the crown. So let me just start with, what about SPACs originally attracted you to it? Because it's not like you were like, you know, Alec Gore's who've been doing SPACs for years. What attracted you to it?
I think that if you look at the process of building companies, the problem is that there is still too few people that provide capital to companies in critical moments. And it causes all kinds of distortions. And one of the most non-obvious distortions in the market is that we tend to fund easy things and we tend to run away from harder things because harder things tend to require more money. And there's a really bad trade-off that happens between investors and entrepreneurs. So the observation was that if you had a SPAC, it was a very elegant way for highly qualified investors to just put a lot of money into a company in a moment where that company also had to build a model, explain themselves, understand their business. And I think that that was what originally attracted me to the thing. And so, you know, the first 4 deals that I did were really capital-intensive businesses: space, real estate, banking, healthcare. These are the kind, and then the last 2 deals I did were in chronic kidney disease and ADHD. So these are not things that you can just spend $2 or $3 million and go to an incubator and the problem is solved. And so we had to raise billions of dollars. I think we raised more than $3 billion across these vehicles, not just from myself, but from other smart investors. And I think that was what attracted me.
Well, I'm wondering, you know, the SPAC boom came, I mean, partially came after the pandemic or during it, but it also came at a time when you still had this massive bull private market, right? You had not just firms like Social, but you had, you know, the Fidelities and the T. Rowe's, huge amounts of cash going to private markets. If you were a startup or a privately held company that had those capital needs, you could get it from private investors, so why bring them public?
You could not get it in the way that you needed. And all of those companies basically needed very large amounts of capital in one fell swoop, which would have been extremely dilutive in the private markets. And the reason is because the private market investor's job is to buy themselves a margin of safety. And their margin of safety is time. It's not liquidity, right? So if you think in the marketplace, you have 2 choices. You know, I could take $1 billion of risk today. If I do it in the public market, the great thing is I could sell it in a nanosecond. I could buy it right now and I could sell it in a second from now. In the private market, that's not true. So I have to buy myself duration. So what do? You price the thing at a point where you give yourself a lot of ownership and a ton of time. The problem with that is that a lot of these great entrepreneurs could lose control of the business. It could get misdirected and misrun. And so I don't think that's actually true.
You know, one of the, if not benefits, at least one of the selling points of SPACs for sponsors and for the companies that were going public was they were allowed to provide kind of more or longer forward guidance than were companies going public via traditional IPOs. So if you were a company, say, that hadn't even commercialized yet, you could talk about maybe what you were planning or expecting in 4 years, 5 years, whereas if you were going public traditionally, you could only go 2 years out. So I'm curious, was the rule wrong to let companies talk so far out, or is the rule for traditional issuers wrong that it only limits them to a couple of years?
I'm not sure that it's true that in a traditional IPO you can even speak 2 years out. You can speak in the past, but you're not allowed to speak about the future.
Yeah.
So even if you wanted to talk about next quarter, you couldn't. But if you're asking somebody for $1 billion, I think it's a fairly reasonable trade-off that you have a chance to explain yourself. What do you want to do with that $1 billion? Are you going to go and buy a bunch of Kind bars and upgrade your offices and give it to WeWork? Or are you going to invest in sort of fundamental technology which has this sort of payback cycle so that the investor has a chance to transparently decide whether that risk is worth it for him or her? So my perspective is that that is a thing that has to get figured out if you want a vibrant capital market. If you want entrepreneurs to go after hard problems where you need a ton of money, at some point that problem will need to be solved, not just in the private markets.
the kind bar we work strategy might have worked better for certain companies that went public via SPAC than what has happened. So my big question, and leave your deals not aside, but incorporate, what went wrong for the market as a whole? Because the vast majority of SPACs are getting crushed.
We are learning what went wrong, which is that we had a decade plus of zero interest rates. That is what fundamentally was wrong. It perverted the market. It distorted reality. It allowed manias and asset bubbles to build in every single part of the economy, whether it's digital trading cards or art or cars or real estate or NFTs.
But SPACs have gotten hit more than most,
no, that's
most
not
public,
true.
most public securities.
That's not true. So if you look at the SPAC index, I think as of Friday, the SPAC index was down, I think, 56%.
Yeah.
That is not true for some tech companies, which are down 80 and 90%.
For some, but not the indexes.
Of course, you're right. The S&P index is down 22.5%.
Yeah.
The point I'm trying to make is that when you provide free money into a system, manias will build. And these manias were broad-based. And now that we've taken money out of the system, these manias will end. And you will find the market clearing price for a lot of securities. And I think that that's a healthy process. But I think it's unfair to just look at one asset class. It was broad-based. There are some great tech companies that have been, re-rated meaningfully worse than, a bunch of SPACs, as an example. Like, is Coinbase a bad company now that it's down 80% from its IPO price? I would say no. So did it matter how it went public via direct listing? That isn't the point. The point is that we had misallocation of risk because the central bank was giving all of us free money. And we all took advantage of it, and it influenced us essentially putting a pause button on the part of our brain that said, let us actually price this risk appropriately.
One of the criticisms of SPAC sponsors, and you're part of this because it's been written about you and about kind of some of the SPACs, is that sponsors often can and do get out of the deals, make money, and then the companies fall and the retail investors who bought in end up kind of holding the bag. Is that a fair criticism, and how do you view that? Because you've done fairly well in your SPACs in aggregate, even though a bunch of them are trading well below where that $10 price.
I think there are people, when given all of this free money in the last few years, that bought all kinds of things and then held them for all kinds of periods. And then at some point, some of those folks probably made money in certain securities. Some of those folks didn't. For example, you can look at take the top 5 tech stocks. Those represent what? A quarter of every single dollar of the S&P 500. Did some retail investors continue to hold those all the way down? Probably. Well, what's the recourse? Should we be able to go and ask, Sundar and Zuck and, Andy Jassy, what do you ask them? For the money back that they lost? Like, the point is that...
Well, you asked Mark what the hell he's thinking, but that's different, yeah.
I did not mention Zuck, but yes, you could ask him as well. The point is that the markets are about making informed risk-reward decisions. And there is no easy way out. This is not a game that was meant to be gamified on Robinhood with confetti in an app. That's not what this is. If you're really going to try to be good at this business, and I've been doing it for 11 and a half years across multiple asset classes, what I have learned is that it is really, really, really hard. And the biggest thing that I learned was how much of my early success was probably not attributable to myself. So on the same way that I sort of blame Jay Powell for zero interest rates, I think I massively benefited from Powell and Bernanke and Janet Yellen before.
Do you get a sense that venture, because your primary job is as a venture capitalist, that venture capitalists, call of your generation, your era, who've been doing that period of time, do you feel they've internalized that? Because I've heard you say that before, that the zero interest rates really gave you a major
There's
tailwind.
A narrative fallacy in Silicon Valley. We have been telling this lie, which is that this is an artisanal craft business. It's not true. We have actually had a massive tailwind because we had a zero interest rate environment that allowed us to raise unbelievable amounts of money from investors who frankly had very few other alternatives because interest rates were zero. And what it allowed us to do is crowd into companies. Many of those companies had unbelievable valuations. Eventually, these unprofitable businesses went public, and only now are we starting to sort out what are good and what are not so good businesses. And the entire time, people would say, this is an artisanal craft business. What I would tell you is it's absolutely not that. Now
What is it?
It is like every other asset class in investing, which is that it is about a systematic model of risk management, capital allocation, and the insight to make good investment decisions, which may not be the answer that a lot of people want to hear, but it is the truth. I'll give you just one example, okay? Over time, in our organization, we've invested more money in every single fund, okay? Starting in 2011, it was a $275 million fund. Our 2019 vintage was $1.5 billion. Okay, we've had different LPs. Sometimes it was all entirely my own money. Other times it was me and LPs. We've been in all kinds of markets. And in that entire time, what I've realized the most important thing to do is we manage risk really carefully. We think about correlation. I talked about this on the All In podcast, which is when we do a deal, how often are we crowding in with other people? The more crowded you are and the more correlated you are, the more at risk your returns will be. We've compounded at 32.5% for 11.5 years. Every single fund is top quartile. Every single fund, by the way, is almost crystallized, meaning, so my point in telling you this is it is possible to run it like a boring machine.
You know, a piece, you talk about being an artisanal business. The other thing that kind of rose up in the last 10 years was this concept, I'll say generically, of value add. You know, we, not just sitting on the board and helping, you know, make an introduction to the head of engineering somewhere, but, you know, lots of support services and marketing services and tech services, et cetera. Do you feel all that starts to fall by the wayside? Because you know, entrepreneurs had gotten to the point where they viewed VCs primarily as just money and viewed them on the boards as minor annoyances.
I think that part of why that may have happened is that we are undereducated as practitioners. I think a lot of venture investors are unfortunately financially innumerate. They don't understand risk management, correlation, alpha, beta. They don't want to learn about these things. They're afraid of what it means to confront an entrepreneur.
Can I ask quickly, is that because the industry changed? You know, I mean, 20 years ago, so many people were either coming out of banks or maybe even out of consulting firms, whereas the shift was, and granted, to be honest, you're kind of part of this from a resume standpoint, people started coming out of tech companies and from operational roles.
It doesn't matter where you come from. Some people have investing mindsets, some people don't. You can resume build in any organization you want, but when push comes to shove, the ability to take risk and make money in all market conditions is a learned skill. It's not a behavioral thing that you're born with. And I think that people who embrace the development of that skill, who want to develop mastery, will do really well. Venture capital has never had to do that because it's been very small and cottage. However, we now see that technology is absolutely pervasive in society, that it will lead us out. Right? If we're in a recession over the next 2 years, what will lead us out? It'll be this kind of growth.
Are we going to be in a recession in the next 2 years?
Absolutely, yes.
Okay.
So
it's on the record on that.
I mean, I hope it's not true, but I think the odds are very, very high that we are. But my point is, tech will become, and venture capital will look like, in the next 20 years, private equity and hedge funds and everything else. Systematic, systematized, right? Mechanistic.
Okay,
that's good.
It's interesting you say that. So for what it's worth, I reported recently that Chamath is out trying to raise money for social capital. He's not going to talk about that because there's probably someone from the SEC here and he'll be let out in handcuffs if he does. But let me ask one of the... Unless you wanted, you want to talk about it? You want to talk about fundraising?
I mean, I've been handcuffed before, but not by the SEC. No, just kidding. Go ahead.
BFD After Dark will be tonight, starting at 10 p.m. down the street. Let me ask... you know, one of the things when you changed social capital, which as you said, you know, had been a traditional firm in terms of, you know, raising outside capital, and you kind of moved into a family office. One of the things I heard at the time was one of the things you had been doing internally was making the firm, call it a little bit more algorithmic, and feeling that the human touch in terms of investment decisions maybe wasn't needed as much, and you could maybe automate some of that. A, was that correct that you were doing that, and B, were you right?
It was correct, and no, I was wrong. It didn't work. But it's a very good question, and again, it goes back to what does the venture industry need to do to really mature to meet the opportunity at hand? Like I said, we need to be more mechanistic and look like everybody else. And so in our organization, I have a North Star. Now, this may really not be appealing to certain people, but our North Star is what is our aggregate rate of compounding. That is it. Nothing else matters. And every time I feel that we're decaying, and there's a couple of sub-metrics underneath. Another metric, that we have a table, it's like the wall of shame, okay? If you walk into our office, you'll see a table. On the left-hand side, it's where we've made our biggest winners. billion here, 500 million there, whatever. But on the right-hand side is our biggest losers. We have never lost more than $27.5 million in a deal.
What
ever.
Deal? What deal?
Well, there's been a couple
I
of
mean,
these.
it's on your wall of shame.
Yeah, I mean, Sprig, we lost 27 million. Premise, we lost 27 million. But there's a bunch of these. I'm happy to tell you.
Yeah.
You know, but my point is, the ratio is 24 to 1. Why is that important? I think it's really important to make sure people understand walking in the door what the goal is. The goal is not to make friends with entrepreneurs. It's to have them respect you, not to like you. The goal is to return a ton of money back to your LPs. That is it, and that's measured in that one number. So I would experiment a lot with different ways to do that job. Big teams, small teams, generalists, sector-specific experts, always guided by that thing. So Dan, what you saw was a lot of my experimentation. And by the way, for those of you guys that understood what I did at Facebook, that's what I built. It was an experimentation machine. It was how do you build the machine to build the machine? And I think investing can be done the same way, and I set out to do that here as well.
I wasn't going to ask you this, but I'm curious. You just brought up Facebook. Your job at Facebook was in charge of growth, basically. If there was, and they've plateaued at least on the Big Blue app. If you were back at Facebook, what's the one thing you would do to get user growth going again?
Look, I just did the Lex Friedman podcast. It'll come out in the next couple of weeks, and he asked me this question: what would you do if you were CEO for a day? I'll give you the answer that I gave him, just to be consistent. I think that Facebook is probably the best company in a position to build the critical piece of AGI that is not yet available. So if you take AGI and you decompose it, this is just basically general intelligence. I think that you can summarize AGI as there's cognitive compute and then there's reasoning. That's how your left and right brains work together. You can do math and you can emote, right? You can feel and you put the two together, you reason. If you think about what Facebook has is they have the most prolific data set on all of that emotional reasoning. Every single reaction to every single possible stimulus is actually documented in every single Facebook post, WhatsApp message, and so the idea that you could take that and Instagram and pour it into a learning system. So if I were the CEO for the day, I would probably double click into that idea. It takes meaningfully fewer people than are probably there. It takes a lot less money than one has to spend to build the complicated hardware infrastructure. But it's deeply differentiating over the next 20 years.
You brought up earlier the podcast, and for those who don't know, Chamath is one of 4 regular people on the All In podcast.
Besties.
The besties, right. So let me actually ask, so the conceit of the show is that you are 4 friends, you have different opinions on different things, and you get together either virtually or in person, and you have a conversation. It's almost kind of like a group of people over a bar or dinner table. It's become, I will just say, weirdly popular.
Weirdly,
I mean,
weirdly popular.
Weirdly popular among people who don't necessarily care about what you do for a living. You've obviously gotten in some trouble for some things you've said on that show. I'm curious, given the popularity of it, do you now find yourself sometimes checking yourself, or do you feel greater responsibility for everything you utter on it? Because it isn't just 4 guys around a table at your house. It's going out and a lot of people are listening.
Yes and no. I think what I've learned is that as I've evolved as a human being, as I've had a little bit more professional success, and as I've frankly just learned to have healthy relationships around me and all of that stuff, I've become sort of like a better, calmer, more focused person. I think that the pod is a very good way of doing something that Silicon Valley desperately needs, which are reasonably decent brand ambassadors out to the rest of the world that show that old caricature of this dilettante person in trying to ape Steve Jobs in the way we dressed, that chapter's closed. And that there are professional, serious people there that understand how to interface in the rest of the world. And I think that is part of my responsibility now. I mean, I'm old, I can't do this. I mean, there's these things that were written about us and me, whatever, at Facebook and even Social Capital. That works when you're in your 20s and 30s. The dog doesn't hunt when you're 46,
I'm curious.
So the pod is just a way of showing that level of intellectual rigor that other people can attach themselves to that says, oh, these are normal people. They're not, running around in T-shirts and Birkenstocks and
you said that. I'm curious, though, if something, not even if something controversial comes up, I assume when you're sitting there and you say something, and obviously the Uyghur line is the one that some folks remember, do you in your mind think, oh shit, that's going to be everywhere on Twitter, or do you not? I will tell you, somebody who sends a newsletter out each morning, I'll tell you, the minute after I hit send, I spend the next 5 minutes just staring at my inbox, waiting for the, oh, you really screwed this thing up emails to flood in.
I don't think too much about it, to be honest with you. We ship it. I always watch it in its entirety, end to end, just so that I have the full context, usually that Friday night or Saturday morning, and then I kind of move on. Most of the time that I'm spending is just doing my day job. You know, people ask, how do you prep for it? And I would really encourage all of you, find a good group of friends. I have such a group. We have a group chat, and the whole point of the group chat is dump interesting things that will challenge the way that you think. And it's a safe space for us. We do it on Signal, so the messages get deleted as well. But we really go after each other and push boundaries around what people think. And it allows me to build a mosaic. And so I really come in, I do a 15-minute prep for All In. Now, you may say we should do much more, but that's all it is, because it's important to just have a snapshot of your mosaic at that moment in time.
I'm out of time, but I'm going to ask one final question because we discussed it backstage, and this kind of goes to your day job and what you're doing. We had a story yesterday, Sarah Fisher, who you'll see in a couple minutes, wrote a story about Mr. Beast raising a ton of money. I'm just thinking about what you do in terms of investments, and you had some interesting thoughts just in terms of thesis, in terms of kind of the change in creators.
Yeah, I mean, look, if I could leave you with a parting thought for all the investors here in the room, but also the entrepreneurs, I think there's these two tectonic plates that are moving in the world that I would just encourage you to pay attention to. The first is that because of all of this money that we've written into the last three big laws, the BIL, the CHIPS Act, and the IRA, we are pulling forward America's energy independence. The cost of producing energy in this country is going to be zero before you know it. At the same time, the cost of marginal compute is going to zero because of the amount of chips that we're going to be able to spin up using GPUs, ASICs, FPGAs. When you put these two together, there are going to be enormous implications to the energy infrastructure, to healthcare, to all of this stuff that's worth paying attention to. Most of my time is decomposing that problem to map out where I want to put money. There's one outlier to this, and that is related to content creators. I have never, ever looked at consumer investing since I left Facebook. Just to be clear, ever put a single dollar.
You also said you stopped using Facebook when you left Facebook.
I did. So if you look at the platforms, Apple and Google, those guys over 5 or 6 years, in the first 5 or 6 years where they established their platforms, Android and iOS, billions of MAUs, monthly active users, trillions of dollars of enterprise value created. Then in the mid-2010s, Facebook, Snapchat, TikTok, WeChat, QQ, billions of MAUs aggregated, trillions of dollars of enterprise value. Content creators, billions of MAUs have not yet seen the trillions of dollars of enterprise value created. So other than energy and compute, on the consumer side, this is the obvious tidal wave. And so the thing around Mr. Beast, whoever does that deal will be a really good-looking genius.
Will that be you?
I mean, I'm not doing this deal, no, but I'm just saying.
Just checking. Chamath, thank you very much.